Good afternoon, ladies and gentlemen, and welcome to the PCI-PAL investor presentation. Before we begin, we would like to submit the following poll. For your information, throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. The company may not be in a position to answer every question it receives today during the meeting itself. However, the company will review all questions submitted and publish responses where it is appropriate to do so. These will be available via your Investor Meet Company dashboard. Finally, we'd like to remind you that this presentation is being recorded. I'd now like to hand over to James Barham, CEO, and William Good, CFO of PCI-PAL. Thank you, gentlemen.
Thanks, Mark. Good afternoon, everyone. Thank you for taking the time to come and meet us, be it virtually today, following our year end. As Mark said, today you've got myself, James Barham, CEO, and with me I've got William Good, our group CFO as well. William and I are really pleased to be able to introduce you to our story at PCI-PAL, provide you with a trading update for the year, and some reflection on the impacts of COVID-19 as well, which is, of course, something I'm sure you want to hear. We're planning to present for something like 30 to 40 minutes and then have some questions at the end. I'm afraid that will be mostly me at the beginning, but we will get to William at some point as well. I will keep a close eye on time as we go through. A quick background on us. So in terms of myself, I've been the group CEO since October 2018. Prior to that, I've had a number of roles within the group, most recent being COO, where I was based out in the US at our Charlotte office in North Carolina. And I spent a year there setting up our North American operation and building the team that we have out there today. My background is very much contact center throughout my whole career, tech, and a mixture of skill sets across commercial, sales, relationship management, and operations. It's important, I think, as well, that I give a bit of background on the company story as well. Prior to PCI-PAL, I was one of the founding members of the small team that created PCI-PAL from within what was another group, be it under the same company registration number, over 5 years ago now. And since then, that group, as it was, changed its name to PCI-PAL PLC in September 2016. Selling off its other businesses, raising over £6 million in proceeds as a result of that. And overnight, we went from 200 plus people to just 11, which was the small PCI-PAL team at the time. We have since then raised in the region of £10 million through 2 funding rounds, most recent of which was in March this year. We have an institutional shareholder base with 40 to 50%. And frankly, we've got some really supportive long-term, very interested retail holders as well. So I'm very pleased to be able to use this platform to talk to you guys today. So, you know, whilst we do have a much longer history as a registered company, we sort of view 2016 as our rebirth as PCI-PAL. We've embraced the good parts of the scale-up way of being, and we've been able to blend it with the PLC side of life to produce what we think is a really great place for our people to thrive in, which, having gone from 11 people to nearly 60 in a fairly short period of time, as a small growing tech company, is really important, particularly when you're working across a number of different time zones. So in terms of our mission and vision, mission's fairly straightforward. We provide organizations that engage with customers by phone, in particular in contact centers, with globally available cloud-based solutions to allow them to be compliant with the latest security standards, in particular payment security standards and requirements, and to ensure that their business is secure and protected and de-risked. Our vision is front-loaded with a channel-first go-to-market model, primarily selling through partners, reseller partners. And our vision is to be the go-to company that those partners, technology companies primarily, turn to achieve secure payments for their own customers. And we achieve this through easy to deploy, light touch technology integrations through our cloud-based platform. And we want to be able to do that anywhere in the world. And as I've already touched on, people are important to us. And our people underpin that. And many of our people, we've got very high retention rates within that small team, are living out one of our core values, which is enjoy the journey. So why is security of customer data important to organizations globally? If you think back 10 years ago, cybercrime was a relatively new concept compared to the awareness that it has today. And companies today are much more aware of the requirements on them and the risks to them for poor security. I mean, points 1 and 2 on this slide are really table stakes for companies serious about data security. There's extensive regulation and commercial requirements on businesses worldwide to be secure. Some of those are regional. You've got state statutes cropping up in the US, like the California Consumer Protection Act, the CCPA. You've got others which have a sort of vast global reach. So PCI Dss, which is where we mainly play, but also GDPR as well, which I'm sure many of you are familiar with. But all of them are about protecting consumer data and governing how organizations manage that. And non-compliance to these standards can be very costly, either through direct financial penalties or increases in cost of doing business as well, because some of these are contractual requirements, particularly when they come down through the banks. Now, layered on top of this, you've the fact that consumers are becoming more and more aware, and it's this awareness and publicity to these issues that's created a real shift towards adoption of more security standards and just responsibility around that within organizations. And trust very much today forms a big part of consumer buying habits. And ultimately, if the worst should happen and a data breach occurs, they can be very damaging, highly publicized across multiple media outlets. We've all seen recent examples of those. This can lead to long-term brand damage. Consumers very much associate a brand with the data breach these days. It gets noticed, it gets remembered. There's some good examples out there that we've seen over the years, PlayStation through to politicians leaving laptops on trains. It creates a stigma around a brand or an organization or a sector. And this means lost customers, it means lost sales. And in the very worst cases, it can have an impact on share price. And in fact, that's something that's certainly becoming more common. In the States, we saw a very large breach with a data handler. Funnily enough, Equifax lost 40% of their market cap. And when those sorts of things happen, that's when you start to see changes in the boardroom. And it's the boardrooms that create budgets for our sorts of services. And all these things combined really produce what is today more of a global climate moving towards responsible data handling. It's happening because it's a good thing to do. And for a number of reasons. And as I said earlier, as our name suggests, PCI-PAL, we play in the payment card industry space. So the PCI data security standard, Pci Dss, which is where we handle and touch and secure customer payment data. So just to drill down into a little bit more detail on PCI, payment data is the most valuable and easy to monetize for a hacker. I mean, that's fairly obvious because it's effectively virtualized money. So if it's lost in a data breach, it's got real value. PCI Dss is a security standard that governs companies' handling and their use of customer payment data. So if they want to take payments from customers by card, they have to adhere to this standard. And PCI-PAL is the highest level of compliance that a service provider under PCI Dss that we can achieve, which means that we can handle data compliantly for any size organization anywhere in the world. And some of our customers are very large multinational brands that you would recognize. PCI Dss has been around for about 10 years. It's a contractual requirement for all companies handling payments. The contractual requirement comes from the merchant bank, who provide the banking services to the merchant, to the company that's handling customer data. But behind that is actually the card schemes, who actually have the networks to process these payments that are pushing the standard down. Behind PCI Dss is the PCI Security Standards Council, Pci Ssc, which was actually created originally by some of the world's leading card processors, Visa, MasterCard, Amex, JCB, Discover. And it's created over the last 12 years, I believe it's been going now, a vast global community focused on security of cardholder data. both from a compliance governance standpoint, so enforcing it, but also within organisations who are looking to de-risk their operation. However, compliance with IT standards is not straightforward. Compliance with information security standards is usually another level of complexity, and PCI-PAL is all about making that journey towards compliance and that journey towards security easier, more effective, and easier to manage on a long-term basis. And we do that by allowing our customers to handle payments without touching their customers' card data. Before I explain how it works in a little more detail, a quick overview of payment environments here, just to set the context within which we operate. So 3 main payment streams that are listed on the slide here in front of you: online, in-store, and contact center. I imagine everyone has experienced making a payment in one of those, particularly online and in-store, although less so in-store recently. But all of these come with varying degrees of complexity from a payment standpoint, and also availability of security solutions. So in terms of online today, websites are relatively easy to secure, actually, typically using a payment provider's web terminal on the website, which traditionally gets embedded within an iframe. So when you go to a company's website, when you type in your card details, you're often keying that into a third-party environment, whether you know it or not. You might be using PayPal, you might be typing it into a WellPay application, but the purpose that serves is that your data doesn't touch that company's website. It goes directly to the payment service provider, and they do that very purposely so they don't have to handle that data. And something similar happens in stores as well. Again, fairly simplistically, when you go into a store, you would use a PIN entry device to pay for something, or a PED, which is what you use for your contactless payments, where you insert your card and type in your PIN. And those PEDs are not typically connected to that company's network. They go straight to the processor. So again, it's keeping the data away from that company so that they don't have to worry about it. They don't have to worry about the security of it because somebody else is doing it for them. Now, contact center, and this is where we come in. So very simplistically, this is a contact center environment, and this is the landscape into which card data may travel when a customer engages with a contact center. Note that we say contact center and not call center these days. This is because agents do a lot more today than they used to, than just answer the phone. They're involved in all sorts of omni-channel interactions with customers, whether that be through web chat, social media, WhatsApp, all sorts of different things. Vast majority still comes through live voice, live agent interactions, but certainly web chat in particular is growing. And typically when a customer engages in a payment with a contact center, there's multiple layers of technology that might touch that card data as it's on its way through to be processed. And often those systems can be mixed between old and new. Some of them can be integrated, non-integrated. Contact centers can be fairly messy technical architecture, fairly messy topology when you take a look at them, actually. Some sectors are a lot worse than others, but this all adds to the complexity of things. And then throw in the mix that you've got lots of people. If you talk to anyone in InfoSec, the thing they probably like the least are people involved in data. They're far less predictable. So customer data can go everywhere, whether that's call recording, screen recording. Lots of contact centers today, most of them have IP voice networks, so the card data, even if it's voice, is traveling as data. Desktop, you've got the agents who hear it. You've got CRM applications which might send the data as web services. There's all sorts of different angles there, and what this ultimately leads to is what we would call a large attack surface for hackers, and it's complex to secure. So it's actually very different to what you can potentially achieve quite easily on a website and in store today. So throw into that mix as well, and as I said, my background and many of the people that work within our organization's background is contact center. Throw into that mix that it's a highly sensitive customer experience environment. Security can easily be at the detriment of service, and that's just not an option in contact centers. So it's important to find solutions to these things that allow contact centers to focus on what they really need to focus on. So how do PCI-PAL solve this challenge? I would say go to our website as well, please, if you want to see this in a bit more detail. I'm limited on time. We've got animated videos and all sorts of good stuff in our knowledge center on there as well. So we effectively sit between the customer and the contact center, as you can see from our logo on that flow there. When the customer makes a payment, PCI-PAL intercepts the card data prior to reaching the company's network, and PCI-PAL transmits the data directly to the company's payment provider, who process this in the same way that they do when we're not involved. We've got integrations with more than 60 payment providers, mostly in the UK and the US, and we're adding more all the time. We can add payment service providers very easily. And typically we intercept the card data by integrating with a company's telephony provider, where the payment's being made by voice. In particular, our partners as well. This is another reason why we're partnered, so that it's easy to intercept that voice flow. But also where there's a digital payment, for instance, so it's going through a web chat form, then the contact center would use our web terminal to handle that data. But in either scenario, the card data doesn't actually enter our customer's network, and the attack surface is effectively neutralized. So our customer, the company, can be compliant under PCI rules as they're using an approved third party to handle their data. So that's how they pass their own PCI accreditation, because they're using us. And they can run their operation as though they don't take payments to a degree. And this leaves them to focus on their core operations and customer experience. So what products do we have to achieve this? We're purposely a pure play, and we purposely have a pure play model, which focuses on securing payments. And we're restricted today purposely to these three core products. As I said, it's a purposeful strategy of ours to be a pure play, and it was part of our channel strategy as well, when we set out on that route late in 2016, as we knew that we needed to create a simple message to prospective partners that had no risk of being perceived to compete with those organizations, many of which are in real high growth markets like the UCAS and CCAS market. We purposely did not want to seem as though we were ever going to tread on their toes. And this is also in tune with our light touch approach to integration. And it's a significant differentiator for us with some of our competitors who have much more of a land and expand type model. Agent Assist is our most popular solution, and has been since day one pretty much. So live agent and customer on a call. At the point that there's a payment, the agent asks the customer to enter their card details using their telephone keypad. So instead of reading those out, they ask them to type them in on their keypad. The conversation remains open throughout. And through our integration with the call flow, we're able to intercept the card data, which comes through as key tones. And we prevent them from entering that company's environment, as I've said previously. And I will just add that the agent gets to monitor the whole process using a small widget application that they use on their desktop. IVR, so it's fully automated payments, very similar, except there's no agent involved. So many of you have experienced IVR, press 1, press 2, and quite commonly will deploy IVR at the same time as deploying Agent Assist. And then our digital solution, which we launched in January, we felt the timing was right, in line with need and demand from our partners. We felt it was the right time to do it. As I said, it is growing digital in contact centers, but it's still the minority if you compare it to voice interactions and voice payments. But certainly longer term, it's where things are starting to move towards. And this enables secure payments through any number of digital engagement channels. We cover all of them with this one product: web chat, social, WhatsApp, email. And effectively works by using secure links that can be added to conversations that an agent is having with a customer through their desktop chat application. It's not our own chat. We can work with any chat environment. Again, it's been set up so that it's very partner friendly. And we've also got a delay payment feature as well, which can be used and sent as a link with invoices. And it's very simple to deploy because it only uses a web form. So our key geographic market opportunities for us today. So our key focus markets today are UK and North America. Obviously, by majority in North America, that's US. We do have partners and a number of partners in Canada and customers in Canada. And we do have customers elsewhere too. So mainland Europe, Australia, New Zealand. But this is mainly where we've been pulled in that direction by our partners, because many of our partners are global, although their businesses are heavily weighted to UK and North America. So naturally, that's where we see that. But we do have the ability to deliver services for them elsewhere. And typically, we're integrated to their global platforms as well. So one integration with us means they can deploy it anywhere in the world. UK is the largest contact center market in Europe, which surprises some people, but it is. The US is one of the largest globally, 5 to 6 times the size of the UK. So it's considerable if you think that UK is the largest in Europe, both of which is something like 2 to 3% of the working populations in those countries working contact centers. And it's around, from the market research, around 70% of those agents are actually handling payments. So you've got a lot of data, a lot of sensitive data, and for us, and a lot of people, and the majority of the market to us, certainly in the US, is where contact centers are either not compliant or they don't have a solution. So they're fairly greenfield opportunities. Most of the customers that we're interacting with, either through our partners or directly. US. So it's important that I draw some focus specifically onto US a bit more. So this is where we've committed the majority of the funds that we've raised in the 2 fundraisers that we've completed. Both the one in January 2018 and the one in March were significantly for starting up and growing our North American operations. It's the most significant opportunity that we have in the business today, for all the market sizing reasons I've just told you. We're also, one of the benefits to our business is that we can deal with any size contact center, which is a real differentiator, we feel, against our competitors. And it's essential because the majority of contact centers across the world are not large. The real volume is actually in the small to mid-size range. And we're able to actually serve those contact centers really effectively and really efficiently through our partners. Many of our partners do target that market, and that's their key sector. And we can also do it through light touch integration through our cloud platform as well. So we're not embarrassed by the fact that we like the small to mid-size sector, but as I'll talk about later, we're also selling into the enterprise space as well now. And believe it or not, we do have less competition in the US. 2 main competitors globally, both UK companies, and there are 2 main competitors in the US. Both of them have different business models to us, as far as I'm aware, different technological approach. And actually both have invested before us, but we do feel like we're now starting to build the most momentum in the market, particularly with our focus on channel and our early adoption of cloud. And as I said, channel's key for us. And the US is actually home to the majority of our partners. It's where they're HQ'd. It's very common that large platform providers in the telephony space are actually US owned. So US is important, not just from a regional perspective, but globally for PCI-PAL as well. So in terms of our technology and our cloud platform, we're truly virtualized within Amazon Web Services, AWS. We were the first to do this in our space, and we're the only one today with a true cloud presence globally, which has been really essential for our partners. And it's one of the reasons we did it, because we wanted to partner with global cloud enterprises, and it was a requirement from them. Prior to that, we were privately hosted data center environments within the UK. We launched our virtualized environment within AWS in October 2017. So it's reaching some good maturity now. We took a real longer term view when we first started working on that. As you imagine, we launched it in 2017. We've been working on it for some time prior to that. And we've focused a lot of our product development efforts actually on that cloud. So enabling us to scale globally, scale capacity effectively, cost efficiently, and to align ourselves with our partners and future customers' technologies as well. Cloud to cloud integrations work a lot better than cloud to hardware. In fact, they just don't want to do it. And we know that There is an evolution going on right now from on-prem to cloud. So we're seeing more and more customers, particularly on the enterprise side, moving to cloud. So we'll be in a good position as that evolves over time. We've got customers live across every instance that we have. The most recent sites that we activated were Sydney and Frankfurt, both of which were activated within 2 weeks. So it's pretty quick. The regions are able to be bolted onto the cloud platform easily and quickly. So we've purposely built it that way, so we don't need to go through new security assessments every time we add a site. So we can be really nimble, really quick, really cost effective as well. Sydney, why did we go to Sydney? That was mainly through partner pull. So we have partners, North American partners with operations in Australia, and we have a number of customers in Australia and in New Zealand. Frankfurt, whilst we've always had a number of customers outside the UK, they had been happy to operate on our London site, but obviously for obvious Brexit reasons, we had to do something about that. So we activated the Frankfurt instance for GDPR data sovereignty purposes. As a sort of multi-sited virtualized cloud infrastructure, it means it's highly resilient, highly available. We built it originally with using cloud native methodology, but it's evolved since then to more advanced ways of operating with serverless technologies. We're using microservices, which enable us to be more nimble in our development cycles, more robust in our release processes, and allows us to increase pace generally when we're developing new features and when we develop new products as well. The platform's highly cost efficient, and all of our new sales from sort of early 2018 have been going onto that platform. So our gross margins have been improving as a result of that from that point. We anticipate getting to something like 80% gross margin by within the next 2 years. And in the year, I'll talk about it, Rapid Remote a bit later, but we have launched 2 products, Digital and Rapid Remote. So as I've stated, we do have a channel first go-to-market strategy. It's channel first, it's not channel only. So we do sell direct. We're set up to deal with direct selling, but we're fairly specific about what we will sell direct. And it tends to be, our focus today is more enterprise direct, which is much more similar to working with a large partner actually. So many of the processes and organizational structure that you need to have are already there. So we're certainly seeing more enterprise size organizations looking to cloud for security solutions. So I think we've highlighted that in the year just gone by. We've signed 2 direct, very large 4,000 seat plus contact centers, both of which wanted to rely on security solutions from us from the cloud. So we do anticipate seeing more of that, and we're making sure we're set up for it, but we're still very much channel first. So to do channel right, you need to commit to it. And when we first went into this with our new plan in our FY17, we set out an objective to become a channel first business. And within 2 years, we achieved this. That's what we told our investors. And today we are 80% plus sales from partners, and it's likely to hover between 80 and 90%, frankly, with the remainder of it being strategic direct. So I don't envisage it going above 90%. When I say to people that we're committed to channel, I often get asked, well, what does that actually mean? Well, it means it's ingrained in our organization. So considering our people, we have gone from 11 to nearly 60 people. But we make sure that if we're hiring people in sales, in marketing, we're hiring people with extensive channel experience. We often hire people with a mixture of both. We hire people with professional networks that reach into our prospective and existing partners' networks, so that we can open relationships easier. When I took over in 2018, we also shifted the leadership of sales to a global role. We moved it into the US. That was strategic on the basis that the majority of our channel partners are headquartered in the US. And additionally, we provide significant support services to our partners to best allow them to succeed with us, because if they don't earn from it, we're not going to get much from them. So we use all manner of things to do that. Our partner portal gives them all sorts of access to sales, marketing, training, support. We put a huge amount of effort into onboarding them, enabling them, as well as building commercial agreements with them, pricing arrangements that actually enable them to sell. So we're quite flexible in that regard. We categorize our partners into 3 groups. Referral partners, typically these are agents, master agents, or VARs, value-added resellers, and they'll refer business to us. Solution providers, so these are the likes of systems integrators or payment providers, and sometimes we have some integration here. So some of these projects, we have some pre-existing integration if the systems integrator is selling our service bolted onto one of our partners, for example. And then we have integrated partners, which are platform providers like Genesis, but then also some of the high growth sector of CCaaS and UCaaS, the cloud contact center and unified comms space. And we've got some very strong names you can see there in that space. These are highly repeatable integrations. So we integrate once and we don't need to do it again, which means we can deliver projects really quickly. And yeah, there's certainly a growth space for us, and it was very much part of our plan to lead the way in our market and partnering with those organizations when we started moving to the cloud several years ago. The partners shown on there are partners that we can mention. It's not all of our partners, but we've got PR out there with all of these. So, you know, we do believe, careful how I say it, but we do believe we lead the way in cloud to cloud. I think that's testament to that, those organizations that we work with and that we're integrated to. We're gathering real traction with these organizations now. I think that's been shown in the increase in TACV over the last couple of years, our sales metric, which William will talk about shortly. We've really been moving those relationships on that we've won over the last 2 to 3 years. 8x8, Vonage, Talkdesk, Genesis. You know, these are very well funded, mostly pretty large US headquartered organizations with a global reach. We've also been successful with specialist payment providers as well. So that's a bit of a niche for us. The reason specialist payment providers, because they kind of understand things around e-com a bit better. So they do actually have an understanding of contact centers, Paymetric, Capita Pay 360, and Civica in the UK. Capita and Civica, both prevalent in public sector in the UK. And as a result, we've got a pretty strong presence in public sector, which also includes 2 of the largest public sector contact centers in the UK. You get to hear somebody else's voice after this slide. Some highlights for the year. As I said, we've got customers live across every area of the platform. Very pleased with the 2 enterprise direct deals that we signed in the year, in particular the one in the US. You know, the sales timing of these big deals is a bit of a challenge, to be honest, particularly as a smaller company. So we are very cautious with the way that we forecast and budget for those sorts of deals, because you've seen the size of them in our RNSs. They can make a big positive dent, but that is starting to be supported by the volume that we're seeing coming through from channel. Added our omni-channel offering in the year. We do have an awards strategy. Bit skeptical about awards generally, but the award that I've listed there is one that you don't pay for. You win that on merit. We won that from working with Genesis on winning a FTSE 100 account off of one of their major competitors, which was also a displacement of one of our competitors. Technology partnerships with Avaya and Cisco, that's important. So we're fully accredited with those guys. It's an important part of our enterprise direct selling strategy, so that we're accredited, because otherwise we won't be trusted to work with those platforms. But also it helps when we're trying to work through their own partner networks. Now, in terms of this displacement point on here, we were not the first to invest in our space in the UK or in the US, but some of our closest competitors invested in the UK some time before us. And by nature of being the only vendors in the market, it's our belief they picked up those partnerships with organizations that we would wish to work with. And the reason I say that is because many of those competitors actually have a direct selling approach. They don't have a commitment to channel. So since we launched, we had to introduce a displacement strategy, primarily in the UK, but we've also raised our eyes into looking into Ireland as well. And in the year, we've successfully displaced competitors at 3 new resellers. 2 of those in the second half of the year are pretty large VARs in the UK. So really excited about what they're going to produce over the next couple of years. We've actually already sold a deal through one of those. And the other one, we've sold a deal and delivered a deal with the one in Ireland. So really pleased with that. We've had feedback that our commitment to channel, our cloud technology, all reasons that have been cited as to why we're having success down that route. And then finally on this slide, the COVID update, which was fairly extensive in our trading update, but just to run over those points again. So, I mean, we knew early on that we were well positioned as an organisation to handle this. We also felt that our market would be positioned quite well longer term as a result of some of the things happening from COVID, home working in particular. Customer base does not include the worst affected sectors, so travel, recruitment, hospitality. We've got very few customers in that space. We have retail, but we're now seeing retail start to recover. In terms of our people, working from home was pretty easy for us. Small and nimble, 60% of our staff work from home fairly regularly anyway. We've actually been really very busy, so we've certainly had no furloughs. In fact, we've tentatively been looking at some hiring as well, which has been required, although we're doing that very carefully. Our technology and the cloud, everything can be managed remotely by our engineering teams. We don't need to go to customer sites to deliver. In fact, we've never needed to. The main reason we go to customer sites is to build relationships. But I think everybody's having to get used to building relationships over video conferencing now. And as a result, we've been able to maintain our project delivery velocity in the period. So we did mention that we delivered 23 new customers projects in Q4 alone. And that's testament to the improvements that we've made over the last 18 months plus in our delivery capabilities. Partners and customers are adapting really fast to this. We've found, particularly our partners in the cloud space, CCaaS, UCaaS partners jumped all over it straight away as an opportunity in terms of, they're very well set up for home working, for business continuity. And actually, we've done a lot of stuff with our CCaaS and UCaaS partners. We've increased PR visibility as a result of working with those partners, running webinars, talking about security at home, disaster recovery longer term as businesses start going back into offices. If there's a second lockdown and these sorts of things. We've also got a fairly strong customer base in the public sector, which we found has been well protected actually. So we've been supporting a lot of those organisations, local authorities as well, to continue to serve citizens. And then finally, I'll just mention we moved pretty quickly to launch our rapid remote offering, which is our rapid deployment version of our live agent service, which can be delivered a live agent payment service within 48 hours. This certainly drove some additional interest. And as we referenced in the trading update, it did drive some additional sales as well. And it was really us, because we had the capability to do it because of our cloud, we were able to offer it very quickly. And I think we were the first and the only to offer something quite so quick to deploy. So that's been great for us, although I would say that quite a lot of the interest has ended up converting into full integrations. I'm going to hand over to William now.
Thank you, James. Good afternoon, everyone. Thank you for attending. Just before going into any details on the numbers, I'll give you an overview of some of the key metrics that we follow within the business to help give you a guidance as to the progress within the group. Clearly, there'll be a further update when we release our annual accounts, which will be probably in early September, as currently planned, following the audit. So it's very unusual that we're doing a roadshow like this, updated after a trading update. This is partly a hangover from the COVID period. We were planning to have this presentation a couple of months ago, but because of the COVID, we've pushed it to now. So following on the trading update, we were pleased with the results. As James said, we've been very busy. We've kept all the staff from being furloughed, and we are still delivering in line with where we're expecting. So the trading update we gave was that our revenues would be 4.4 million for the year to June, which is some 200,000 ahead of the FinCap forecast. And our loss before tax would be in line with forecast. We were forecast for a 4.2 million loss, and we're going to be there or thereabouts. Clearly, I'm going through those numbers at the minute, and my team are putting that together. But overall, we're very pleased. Revenue growth is one of our key metrics we look at. Clearly, we are a loss-making company, so we're pushing sales through, and this is recognised revenue under IFRS 15. And in the last financial year to June 30, we increased our recognised revenue by 55%, or greater than 55%, to 4.4 million from 2.8 million last time. Now, looking at a little bit more detail, 4.4 million, of the 4.4 million, 3.7 million came from what we call is our recurring revenue, our annual contract value. And that's from deployed contracts that we can recognise that we've sold. A further 0.6 came from the release under IFRS 15 of the setup and professional services fees we charge on each contract signing. Those under IFRS 15 have to be capitalised, and we tend to release that over a 48-month period. And then, if you look in this graph, there's a very thin blue line at the top, which is other income. That covers certain commissions that we've been paid, or additional work we do on specific contracts, which aren't part of the day-to-day operation of the contracts. And this year we generated about £100,000 worth of sales against 50 last year. Looking forward, the FinCap forecast is running at about 6.7 million. And if you break that down more into its component parts, they're expecting £750,000 worth of IFRS 15 release, again, as we build up more and more contracts. And the rest is pretty much coming from our recurring revenue stream. So the forecast has been a reduction from the previous levels at the trading update. We did lower it down from the previous, which was 7.6. The reason we've done that is because of the uncertainties of the pandemic and just the timing of contracts coming through. We cannot recognise revenue until we've A, signed a contract, and then B, deployed it under our time to go live. So we did lower that down to 6.7, but that's still a 50% plus growth, and clearly we hope to achieve that, and I'll explain shortly how we hope to do that. Right, moving on. Points 3 and point 4 on this slide are two of the key metrics we follow. Firstly, we can't drive revenue without selling anything, and so we have a very close interest with our contracts. And we measure against ACV, which is annual contract value. And this is the recurring section of that. Other companies I know look at total contract value, but we found that confusing because some of our contracts were 1 year, some of our contracts were 6 years. And so an investor would get confused as to what the value of that is to our company. So we have filtered this all down into an annual figure. So looking at the last financial year, we signed £2.6 million worth of new recurring revenue in our contract, which is up 37% on the prior year. That was a good performance, and especially as we announced in the trading update, we sold £800,000 of that in the last quarter, right through the middle of the pandemic, which is very pleasing. But on its own, ACV doesn't mean anything. It's the pile of contracts that we have that means it makes everything to us, which will then take us through to profitability. So the next key metric is our total contract value. This measure here is, if you put it in context, if all our contracts were live today, let's say the 1st of July, which is the beginning of the financial year, if they were live today and we didn't sign any more contracts, then we would report recurring revenue as £6.7 million. Now, not all these contracts are live. Certainly, we have about just over £4 million live. We have another £2 million going through the deployment, and then there's a small tail which are on hold as a result of either COVID or resource issues at our customers, which normally take a 6 to 7 month period to sort out before we deploy them. Why do we measure total contract value? Well, ultimately, what I want is to wake up every morning knowing that we've got enough contracts under our belts to cover our cost base. and we are certainly heading towards that basis and expect to pass that threshold in the next 18 months or so. Looking a bit more detail at TACV, you'll see that most of the revenue and most of the contracts we hold are still in EMEA, and most of those are in the UK. Excuse me. This is obviously a hangover from the early days when in FY18 we only had a UK operation, and that operation was selling £2 million worth of contracts every year. And then we launched in 2017, in the middle way through FY18, the new AWS, and that's led to the growth. We launched in the US in February 2018, following the fundraising, and you can see the orange section there is the number of contracts, the pile of the annual contracts we've built up over that 24-month period. We have now finished the year with £6.7 million of that pot, with 5 million in Europe and 1.6 million in the US, and there's a small amount in ANZ, sub £100,000. As James said, those are for contracts we have undertaken remotely for key partners. Why is that important? So if you look at the H2 FY19 column of 4.1 million, that was the pile of contracts we had at the beginning of FY20, the beginning of the last financial year. If you now jump to the end of the financial year, we have just announced we've deployed revenue. We've got revenues of 4.4 million recognised in the accounts. So we use TACV as a guide to our next year's revenue coming through the contract. So if you look at the FinCap forecast, going back to the previous page, 2 pages, the 6.7 million here is the forecast. We've actually got very good visibility of it because we've already got the contracts in under our belt. What we now need to do is make sure those are deployed in a timely manner, and so that allows us under IFRS 15 to start recognising the revenue. Finally, point 5, as James said, 80% of our contracts is the target we looked for through channel partners. It's not necessarily 80% of total contract value or contract value, but over time, that's the key metrics to help us drive us deeper into the markets, especially in the US. Now, point 6, we did raise early on in the pandemic £5 million. That is 4.57 million net after fees, and that has helped underpin the business, which was clearly loss-making. And James will give you a little bit more detail of how we plan to spend that on the next slide. So what does that mean to us? Well, actually, at the end of June, we finished with net cash of £3.16 million, and we had a further 1.25 million of loan facilities available. So we've got 4.4 million pounds worth of cash available to us. However, being a loss-making business, burn rate is important to us. So, do we have enough cash to get us through to that magic profitability? So if you look at the burn rate for FY20, the year that's just finished, we started the year with £1.5 million in net cash and no debt. We raised the 4.57 million in equity, and we finished with net cash of 3.16. So if you do the maths, that's 2.9 million pounds worth of cash that's been spent within the business over the last financial year. And that included paying £200,000 worth of fees for a loan facility we took out. If you take it and look at it on a half-year basis, so since the 1st of January this year, we started the half year with a small net debt of £23,000. Again, we raised 4.57 million and ended with the 3.16. So that had a burn rate of 1.38 million. So one question that's asked often is, we've just recorded a loss before tax of circa 4.2 million, but your cash burn is only 2.9 million. How come? Well, that's part of our business model. We're clearly a SaaS model. We charge for our setup and professional services fees upfront, on signature, and that accounts for £1.5 million worth of cash coming into the business. And where possible, we also charge annually in advance for our licenses. Now, some of our partners don't allow that because they don't charge on that model. Others do. And the difference between the 4.2 and the 2.9 million cash burn is the advance payments we have received from our new contracts. And we are expecting that to continue through to the future. So, for instance, we signed a large contract in December last year with a US company. It's one of the largest private US companies in the country, certainly top 10. And that was a valuable contract. And they have agreed, they've already paid us for the first year's licenses, and they will pay us for year 2 and year 3 licenses on go live, which should be imminent. So to put that in context, that will be, I'll be raising an invoice to them for $1.15 million very shortly. We also announced a very large UK government contract in March this year. Again, one of the key enterprise clients we've been targeting. That's going through deployment and will be deployed shortly. And when that goes live, we'll be able to charge them 1 year in advance, which will be more than £500,000 worth of advance billing. So with our existing cash pile, with the loan facilities and the advanced payments we receive, we are comfortable in getting through to our cash break even, which is scheduled to be somewhere through midway in FY22, so the next financial year after the current one we're in. Clearly, we will be giving more information on the breakdowns of some of our key metrics at the full year, and so hopefully we'll give you a chance to update and speak to you then. I will now hand back to James.
Thank you, William. Just before obviously James takes over with the full year 21 outlook, I just wanted to just give James an opportunity, obviously, for Q&A. So back to you, James, then we'll hand up for the Q&A.
Yeah, sure. Okay, yeah, very conscious of time. So just very quickly, I'll run through this FY21 outlook, and then we'll hit some of the Q&A quickly. I've had a bit of time to look at that. So to sum up, we're generating really strong momentum in all our key sales metrics, which is what ultimately is going to start contributing in our strong year-on-year revenue growth. And will drive us towards our first months of cash generation and profit in FY22. To do that, we need to continue to capitalize on the reseller partnerships that we've got in place, that we've put in place over the last 2 years, whilst adding new strategic partners into the mix as well. And this will produce the scale that we plan for in the future. Just important for me to cover this. So we did raise money in March, and I know that some of you are interested in this. So in terms of that investment, clearly our plans from March are slightly different to how they are today. We're taking a much more we're taking a cautious approach. We've clearly delayed some of the timing of that investment as a result of the lockdowns in the UK and the US. And we're going to be taking it very easy over the next 3 to 6 months as we track our own progress. But the focus remains the same. It's North America product and balance sheet strengthening. But as a management team and as a board as well, we're going to be looking very, very closely at how the business is performing on a month-to-month basis and balancing any additional investment directly with continued growth. So the two things have to be, growth needs to be happening at the right rate for us to make those investment choices, and that will allow us to perform and still maintain the momentum that we want into those specific areas. And we're fully anticipating another big step forward in revenue next year, 50 to 60% by revenue growth by the end of FY21. So just moving to the Q&A quite quickly. So if I take first one from where some of you have submitted multiple questions, I'll probably just have to choose one of them, I'm afraid, because we've had quite a few questions through. So question from Abigail. What is the typical sales cycle to winning new business? So going into the year that we've just finished, it was tracking about 6 to 9 months. It's finished stronger than that. Q4 we were doing deals pretty quickly, so we did actually have one deal start to finish in under a month. The other reason why this number's coming down though is because our integrated partners sell quite quickly, although having a channel model means you don't always get visibility of the opportunity from where you would normally track it from if it was a direct opportunity. So the more business we do through channel and the more business we do through integrated partners, the shorter that sales cycle is going to look. But we're generally looking at around 6 months at the moment in terms of how we plan it. But we do get real variation. And direct enterprise opportunities, they're big, they take longer, and they're much more unpredictable. William, there's a cash burn question from Paul B.
Okay, yeah. So clearly, I've just given you the FY21 cash burn figures, which was 2.91 for the full year.
Yeah.
But FY22 is, we are expecting to hit cash break even in FY22. And so, we will at that period actually start generating cash. That's the current viewpoint. About midway through H1 of FY22 is where we're expecting to hit that cash positive. Our cash flows are slightly lumpy because obviously we do bill 12 months in advance on some of our licenses, so it's on a quarter by quarter trend rather than a specific month.
Thanks, William. There is another one which I think is probably for you, which is from Alan C. Alan is asked, having closely tracked your additions to the annual contract values and tracked that against actual sales, it appears your TTGL has slowed significantly. It hasn't, but William, maybe you'd like to take that one on from a financial perspective.
Yeah, so annual contract values is the metric for the new sales. It does not actually reflect to revenue. Clearly, we can only take the revenue once it goes live under IFRS 15 rules. The bit that sometimes gets missed out is that we do sign contracts, and some of those do go on hold due to customer resources. So if you look back at our announcement for the interims, we announced there was about £500,000 worth of contracts were on hold. And as I said, those take a 6 to 9 month period normally to re-energize before we can then get them going live. So there is always slightly a larger lag, but that's completely out of our hands. We can't deal with it. Once they start deploying, we do deploy within the 4 to 7 months.
Yeah, and I'll just add on that one on TTGL. That was one of the objectives that I brought in when I took over in 2018. TTGL is a key metric within the business. That was when we introduced it. That's why you're aware of it. We've made some significant changes in this business in our ability to deliver projects, and that starts right through from due diligence with our customers up front, so helping them with their own, but also ours of the project, so we understand what we're getting into, working closely with our partners, having more integrated partners as well. Significant improvements in our documentation, statements of work, high level and low level design documentation. It looks a very different landscape. Well, it'll be 2 years in October since we brought the KPI into the business, and it's something that the whole organisation obsesses about. And one example I would give you is that the large deal that we won in the US in December, we actually won that in the end. It was through a competitive tender process, and the final step was a competitive proof of concept against one of our other major competitors. We're not sure which one, but we both went through a project to deliver something for that customer, and we came out on top of that. So I've got every confidence in our team's ability to deliver, and that 4 to 7 months is still currently accurate. Although for integrated partners, we're seeing much quicker delivery than that, much quicker. So we're set many projects now under 2-3 months.
Thank you, James, and thank you, William. Just obviously mindful of time, and I know that investor feedback is very important to you as a company. I'd like to thank you and William for updating investors today, particularly given the restrictions on engaging with investors as a result of COVID-19. But if it's okay with you guys, I'm going to end the session and, of course, enable investors to provide you feedback. Could I ask those investors not to close this session, because you'll be automatically redirected. If you access this meeting from our website, the page will appear. If not, we would ask you just to simply log in to submit your feedback. Just obviously, in the interest of time, if you guys just want to wrap up, and then I will conclude the presentation.
Yeah, well, thanks for joining joining us today. If we'll try and get back to these other questions that we've got, and feel free, if you do have any more to come through, you can push those through to Walbrook PR.
That's great. And of course, as we, as probably investors are aware, all the questions that have been submitted today that haven't been answered, of course, you'll be able to review and appropriately respond where it's appropriate to do so. Ladies and gentlemen, once again, thank you very much for attending the webinar today on behalf of PCI-PAL and Investor Meet Company. Thank you once again. That concludes the presentation for today. Thank you.